A government runs out of money, not a household, not a company, a government. And instead of printing new money, it borrows. That sounds backwards. Because we all know governments can create money. They literally control the printer. So why go into debt at all? This question matters right now because government debt's exploding everywhere. Interest payments are rising, budgets are tightening, and people keep asking the same thing. If they can print money, why don't they just do it and be done? Here's the uncomfortable truth. Printing money and borrowing money are not the same thing. They may look similar on paper, but in the real economy, they behave very differently. To understand why governments choose debt, we need to slow down and look at what each option actually does. Imagine the economy as a giant shared pool. Printing money is like pouring new water into the pool. The water level rises. Everything floating in it adjusts. Prices drift upward. Savings quietly lose value. Borrowing money doesn't add water. It moves water that's already there. When a government borrows, it's taking existing money from investors, banks, pension funds, insurance companies, and promising to give it back later with interest. That promise matters because money isn't just numbers, it's trust. When a government prints money, it creates spending power without asking permission. When it borrows, it asks the system, "Do you trust me enough to lend?" That question is the real reason debt exists. Borrowing forces discipline. Printing doesn't. Here's where the math gets uncomfortable. If a government prints too much money, inflation rises. Not immediately, not evenly, but eventually. Prices go up faster than wages. Savings shrink. People feel poorer even if they're earning more. Inflation doesn't feel like a policy decision. It feels like bad luck. Borrowing delays that pain. Debt spreads the cost over time, across years, across future taxpayers, across people who aren't even born yet. That's not a moral statement. That's mechanics. Now here's the irony. Governments often borrow from institutions they indirectly control. Central banks, state-owned banks, public pension funds. So people say they owe money to themselves. That's partly true, but it's missing the point. The debt isn't about who owns it. It's about what the rules force the government to do. Debt comes with schedules, interest payments, deadlines. Printing money comes with none of that. History has shown this pattern again and again. In normal times, governments borrow. In emergencies, they print. Wars, financial collapses, pandemics. When borrowing stops working, printing becomes the last resort. And every time that happens, the same trade-off appears. Short-term relief, long-term instability. The hype says money printing is a superpower. Free money, no consequences. Reality says it's more like anesthesia. It dulls pain now, but wears off later. Borrowing looks boring by comparison. But boring is the point. Debt keeps markets calm. It gives investors a safe place to park money. It anchors interest rates. It protects the currency's credibility until it doesn't. Because debt has its own limit. As interest payments grow, they start competing with everything else. Healthcare, infrastructure, education. Eventually, the government isn't borrowing to invest. It's borrowing just to stay afloat. At that point, the printer comes back into the conversation. And that's the real tension behind modern economies. Governments don't borrow because they can't print money. They borrow because printing money changes the game too fast, too visibly, and too dangerously. So the real question isn't why governments borrow. It's this. What happens when borrowing stops being believable and printing becomes the only option left?